And moving on to the next session titled Startups and Corporate Governance, Leaving It Too Late. As we get ready to set the stage, we're going to play a short video. Ladies and gentlemen, requesting you to continue to be in the hall. We're moving on to our next session. In a minute, we've got our video. Ladies and gentlemen, we now move on to our next session right here. Thank you so much for your patience. Inviting you to kindly take your seat. Now this next session is titled Startups and Corporate Governance, Leaving It Too Late. Startups constitute the expression of an entrepreneurial spirit married to an aspirational behavior pattern. Growth becomes an obsession with the founders of as well as the investors in startups. Are they giving corporate governance short shrift in the early years? If so, with what consequences? Ladies and gentlemen, we have our panelists right here with us. Please put your hands together as we welcome our first panelist, Mr. S. Ramann. Welcome, sir. A former officer of the Indian Audit and Accounts Service, has been the chairman and managing director of Small Industries Development Bank of India, SIDBI, from April 2021. Before joining SIDBI, he was managing director and CEO of the National E-Governance Services, NESL. Prior to joining NESL, Mr. Ramann was the principal accountant general audit in Jharkhand. Earlier, he worked with SEBI for 6 years, initially as CGM and later as executive director between 2011 and 2013. He also worked as first secretary at the Indian High Commission, London, for auditing the accounts of various Indian embassies in Europe. Ladies and gentlemen, put your hands together. Our first panelist, Mr. S. Ramann. Joining us virtually is our next panelist, Mr. Nithin Kamath, the founder and CEO of Zerodha. Despite being under the weather today, thank you very much for joining us today. After trading in stocks from a very early age and having to overcome hurdles, he bootstrapped and founded Zerodha in 2010 and changed the landscape of the Indian broking industry. He co-founded Rain Matter Foundation at Zerodha and constantly pushes the industry to think about climate and environment. He is a member of SEBI, Secondary Market Advisory Committee. Ladies and gentlemen, put your hands together. He can definitely hear us loud and clear. Mr. Nithin Kamath. And joining our panelists on stage, Mr. Siddarth Pai is founding partner, CFO and ESG officer at 314 Capital. He is the youngest executive council member of the Indian Private Equity and Venture Capital Association and is part of startup councils of CII and AIMA. He has recently been appointed as a member of SEBI's Alternative Investment Policy Advisory Committee and International Financial Services Centers Authority Working Group on development of non-resident individual business and ease of registration for GIFT IFSC. He is a member of the Indian Software Product Industry Roundtable, a Bangalore-based think tank. Ladies and gentlemen, put your hands together for our final panelist and our moderator, Mr. Siddarth Pai. Handing over to you, sir.
So thank you very much. Thank you, everyone. It is actually great to end up speaking at an August forum like this. As Mr. Amarjeet was also saying, I'm actually used to sitting in the audience, so it's actually a great pleasure and a privilege to end up actually speaking on stage with luminaries such as Mr. Ramann and the person who's actually birthed the entire fintech revolution that India is actually going through as of now. The Indian startup ecosystem is actually a remarkable organism similar to the IT services companies that actually came out in the late 90s and the early 2000s as well. India is the third largest startup ecosystem in the entire world, galvanizing over $144 billion of capital, boasting of 115 gross unicorns. Some of the valuations may have come down as of now, so it's better to stick to the highlight gross figure that's there, and actually boasting of more than 1 lakh registered starters with DPIIT. The unofficial figures end up actually putting the number of startups who don't meet the government definition, but are still considered startups at a much higher number when it comes to that. They have in a very remarkable short span of time ended up evangelizing the digital India, the digital public goods that we've had, and ended up actually creating a revolution which has increased the financial penetration that we've ended up seeing, and some of these have become household names as well. I think all of us, when you look at our phones, maybe 6 years ago versus as of now, all the apps that we end up actually using and the convenience has actually been brought to you by this entire unique breed of entrepreneurs who've actually come up with that itself. And indeed, growth has actually underscored the entire startup phenomenon, not just in India, but across the entire world. The greatest mantra that the startups ended up espousing, which was famously actually said by Mark Zuckerberg of Meta, formerly Facebook, is that you need to end up actually moving fast and breaking things. And indeed, we've actually seen that predicate the entire startup playbook over the last decade. And this was buoyed by the fact that we had historically low interest rates. So investors were actually chasing growth, and growth is something that startups promised, and more often than not end up actually delivering upon. But since COVID, for that matter, and the fact that interest rates have actually risen, we've actually seen a sudden freeze end up happening across the entire board. We've seen WeWork, which has been the poster child of everything that's actually wrong with the startup industry, actually filing for bankruptcy as of now, for over $47 billion of peak valuation to something which is actually pennies on the dollars for that particular matter. So we've seen the playbook now actually move from move fast and break things to actually reflect and rebuild. I think that's actually a perfect segue to speak about the role that governance has actually seen. And I think the Indian startup ecosystem has also been marred by several issues of corporate governance that have actually come to the forefront as well. And one of the reasons why these governance issues come about is because of the frenetic pace of growth that these startups have ended up engendering and ended up actually creating for themselves. We've actually seen situations wherein progress has actually outstripped processes of these particular institutions, which was fine when there was an unlimited tap of capital that was actually available for them. Because capital is a great Ganga Jal that ends up actually baptizing any of the sins that people end up actually facing for that matter. So the day the capital tap ended up drying up, we've actually seen, and the tide has actually receded, it's actually become fairly evident who's been swimming naked versus who's actually been fully clothed, for that matter. So we've actually seen this sort of thing of corporate governance come in. And corporate governance, at the end of the day, is a lot like personal hygiene. When you do it well, people don't actually notice it, but when you do it badly, there is nothing that can end up actually hiding that particular stink, for that matter. So we've seen this sort of governance, these run-ins end up coming about. And here to actually explain and to go deeper into this entire field, we have a very august panel. So I'd like to actually start off with the question, with a question open to the entire group as of now. So given the fact that the Gatekeepers of Governance conference has actually reached this particular edition, I think the entire audience and everyone is fairly well versed as to what corporate governance ends up entailing and what corporate governance is. So along the lines of the disruptive nature of startups and the antithetical behaviors they end up espousing, what I'd like to ask the panelists, as of now starting off with Mr. Ramann, is what isn't corporate governance, for that matter? So everyone knows what it is, but what is it not? What are some of the proxies that people end up using to give them the veneer of governance while paying lip service to it without actually following through on what governance ends up actually entailing?
So, very good afternoon to all of you, and thank you to Mr. Damodaran for inviting me here. Sir, it's an honor to be here. Thanks, Siddarth. You, I think, really gave an excellent preamble, and you threw a very difficult question as the first ball. Now, I think somewhere corporate governance gets sort of hidden within the chase for valuation. So, typically, and I think this was brought out in the earlier session by really some chieftains of the industry, to what extent does money cover up the, gaps? And I think when, as you said, the going is good, people presume that corporate governance is in place. Now, I think that is really where we should maybe point the finger and say that this is not corporate governance. So, the financials are kept aside. Corporate governance has its role, and it has to sort of be seen in isolation of what the company may or may not be doing for its shareholders. But I think there is a larger point when we really talk about the larger industry. So, there is a listed space and there's an unlisted space. Now, I think a lot of what we are talking about in corporate governance is the listed space. And we've all spent many years. Mr. Damodaran has been a, sort of pioneer in making corporate governance grow within the listed space. But the entire regulations of SEBI are really addressing the listed space. It is the unlisted space in which we are now talking, and the context really here is, the alternate investment funds and what is it that they are bringing to the table. At a very macro level, I would say that there is a competition between the listed space and the unlisted space. A lot of corporates today somewhere are rethinking whether they even want to be listed. Now, corporate governance, therefore, is lost because many of SEBI's rules do not apply to the unlisted space. So I think there is a huge need to look at this again. Maybe the Companies Act does not have enough on corporate governance. I mean, I'm really not getting into the depth of that because I'm no expert on that. But it talks about principles. Now, who is going to flesh out those principles is really left to the stakeholders. So, what is not corporate governance is a question that does not arise initially when a company is sort of starting off, gets its investors, because there is a crazy idea that the founder has got. And he needs to chase that. He's really not bothered about corporate governance. So let me just, sort of pause there and...
No, very interesting. You've also opened up several avenues for questions, but I would actually like to come to you now and to actually hear from the entrepreneur who's actually built up a bootstrap company. I think more than unicorns being specialties in the Indian startup ecosystem, a bootstrap unicorn, for that matter, is actually the most unicorn of all unicorns. So I'd love to actually hear from you as to what you believe is in corporate governance, and I do have a few more questions along the lines of how you actually built up Zerodha as well as a practice.
No, thanks. So I have like a bad throat, so so I would allow to be there. Thanks to Damodaran sir for inviting. I think both you, Siddarth and Ramann sir, kind of covered it well. No, I was actually thinking, why am I on this panel? Because and I was just the first thing I did was actually Google for what is corporate governance, and it said it's about just running your business well. I mean, that's really what it meant. It said is that you need to if you're running your business well. And I was like questioning, what is running a business well, which is doing what is right for your customer, doing what is right for your your team, and not maybe thinking short term, right? Because I think one of the the way I think of startup is it's kind of I think, a regulatory arbitrage, which is, the listed universe is slower because of all the legacies. And startups can be faster, and this is a game about fast beating the slow, right? As in, it's not about the big beating the small anymore in a tech-first world. And I think, investors in the space almost play it, right? As in, VCs, etc., know that the play here is you can be kind of a little easy on how you're running the business, just to be able to be fast and catch up. And I think that is not the right way to run the business, right? Because and in hence it is probably not good corporate governance. Is how I was thinking about it. It is that when you start prioritizing what is right for the short term over what is right for the long term, you, I think, end up compromising on a lot of decisions that you take as a business. And when I was thinking about what we have done all right at Zerodha is probably that every time we think about any decision, it's always 10 years away, saying that, is this something that will kind of help us in 10 years from now? Is this something I would do to myself as a customer? And, it's just, I think that kind of decision framework is what has, I think, helped us, run this business decently of sorts. But I think, coming back to your question, I think what is in corporate governance is probably, just doing it a bunch of check boxes, right? Like putting a tick next to a checkbox saying, these are 10 things you asked for with, and this is what I've done in a letter, and that's probably not corporate governance.
No, true. I think that's actually the way most of us. I actually wrote my exams fairly recently, for that matter. So not recently, about 10 years back or something. But that's more or less the way we ended up actually studying for exams. It doesn't matter what the syllabus was. If we knew there was a question bank of 200 odd questions that would actually come from, might as well learn the 200 questions and never end up reverse engineering the answers as opposed to following through on the practices that are actually there. But so coming to you, as now, you did actually touch upon the role that regulation actually plays when it comes to corporate governance. But just to actually counter that, every regulation is actually one clever lawyer away from subversion, for that matter. We've actually seen, I think, the Companies Act being fairly replete and become extremely onerous on compliant companies who wish to actually follow that, whereas the ones who wish to subvert regulations end up actually doing that. And the regulation as a deterrent is actually a function of enforcement. And there's still, I think, a few ways to end up actually going for enforcement. So what role does regulation have to play to end up engendering corporate governance, given that Nithin has also said that when actually the simplest razor to apply to governance is the fact that I would actually like to do what would actually be done to me. So what role does regulation have to end up playing over there, and how does it play into the Indian framework when it comes to it?
So let me start by tipping my hat to Nikhil, that if you've actually gone and looked up what is corporate governance today, truly, I mean, you've got it right. So I'm just saying that one, reply from him is, if we weave that into a reading of the Companies Act, the Companies Act is not asking for you to stand on your head when you're running a company. Now, if you're by character and by interest to serve your customer, you are taking a certain set of decisions and you're moving ahead, you probably are not going to find yourself in those situations of conflict of interest. So, at the heart of, corporate governance is really conflict of interest. And I think all regulation is trying to narrow down those conflicts situations. So, we are getting obsessive maybe with regulation, but again, I'm clearly making a difference between the listed space and the unlisted space, because in the listed space we have the retail investor. And I think really a lot of regulation is because of the fact that we have investor protection of a retail investor. And therefore, it is equally, argued on the other side that when you have an industry called the AIF industry, which is now sort of, as you said, we are the third largest, etc., but we are still, I think, very small on that entire AIF industry. It has a huge future if we were to just look at it as people who do not need investor protection. Then how would we approach the entire problem? So you're then talking about, it's the Companies Act and the rules thereunder which govern the companies that are put together by the AIF industry. And we are really talking about some serious, the unicorns, I mean, it's a matter of valuation, but the fact is that those unicorns are for real. I mean, they have created huge value and people have benefited. So, we are talking about the need for corporate governance to come in to a host of companies where regulation can be kept at the door. We don't have to allow regulation to come in. Now, that's a debate that's going to continue forever. And I think if we are talking about leaving it to the stakeholders to guide the company forward, we probably should continue down that plank, and where we find that there is a rotten apple, that's really when the covenants and clauses of the Companies Act would really kick in. And it's open for any stakeholder to then knock the door and take that forward. So I think we have seen, again, I'm talking from the AIF industry because, as SIDBI, we have now supported, I think, over 110 AIFs, which have then gone on to putting money into over 1,000 startups. And in that 1,000, we've got, I think, 23 unicorns as of yesterday. I don't know what the value number is today. But the point remains that as LPs in an AIF, what are we doing to engender corporate governance in those startups? And those are of high value. So, do we need a SEBI regulation to help us? Probably no. But to the extent that we have investors who may end up going and knocking the door of the regulator and saying, listen, we've been sort of, sold a lemon, then you have a problem. So it's really about drawing stricter boundaries. And I would really say that in the entire AIF industry, if we are talking about bringing in domestic capital, which certainly exists, we just have not tapped it enough, and of course the large pools of global capital, we would be wise to go back to the drawing board and ask ourselves that question again, that how much regulation do we really need within this space?
No, that's actually a very fair point, because what is supposed to be a light touch regulation should not actually become onerous for that matter, because the sophistication of the investor is something that has to be a tangible input into any regulatory framework that ends up evolving as well. There's no point actually creating a sort of nanny state in terms of set of regulations. If there are people with eyes wide open who wish to actually take certain kinds of risk, they must be able to accept the downside of that risk as well, not only expect the upside to end up actually coming there. But I'd actually like to shift to Nithin as of now. Nithin, given the fact that Zerodha is actually the bootstrap beacon of the entire startup industry for that matter, and you yourself said that investors actually have a role to play. But when you started off Zerodha with your brother, and consequently he actually has a investment fund known as True Beacon. I wonder if both of them are actually linked. How did you guys actually think through these kind of particular practices for that matter? Because we've always heard about corporate governance being a function of independent directors, externally driven mandates, a set of regulations. But you've actually created a very, very well-run shop for that matter that's actually engendered trust during the entire space. So there would have been occasions where you also would have had to tackle with going for the low-hanging fruit, actually taking what I actually like to call regulatory innovation, or taking that kind of risk that actually violates the spirit of law as opposed to the letter. So what is the kind of moral compass that you actually kept in place that I'm sure that other founders would love to actually learn from and end up actually emulating over time?
Yeah, no, thanks for that, Siddarth. No, so when we started, so before Zerodha started, I mean, the way it started was Nikhil was a better trader than I was. And so the plan was he continues trading and I'll attempt building a broking business, be a broker that traders like us didn't get, right? And so I think, when I was thinking about panel and questions, and I was thinking about it, like, how is this whole decision-making framework, right? Because it's not like I read a book or something like that. I mean, and to be very honest, I actually for the first time saw what's the definition of corporate governance today. And, but I think what helped was as a trader, right? I think, the way you can trade well is to think of everything as a risk and everything as an opportunity, right? The problem, I think what I see generally in the ecosystem, especially in the startup world, is that everyone's looking at everything as an opportunity and not as a risk, right? Eventually, everything comes down to risk to reward, right? I mean, it's like, what do you do? What do you don't do? And, and you need to be able to say, what, this is not worth the risk, because the reward is not enough for this, right? And this is, I think, in my genes right now. In the sense is, Like, anytime I do anything, I'm just evaluating everything in terms of risk to reward. And, like Zerodha today gets a lot of credit for tech and, low cost, kind of bringing down prices, etc. I think with actually the true disruption, what we did back in 2010 when we started, was actually in terms of transparency, right? We thought financial services businesses are very opaque in the way they work. And that was a real problem to solve, right? And we said the only real way for it to be solved is that if you have just one offering for all of your customers, right? So, which is actually was very disruptive. A lot of people had tried low cost broking before us, right? But what was different was that we said every customer of ours will get the exact same deal, which means it'll give us kind of an opportunity to be very transparent as a business, right? I can talk about, like today we have, I don't know what, 1.3 crore plus customers, and everyone has the exact same deal. There is no differentiated offering, right? In today's tech first world, it seems a norm, but then this isn't how financial services businesses work, right? Uh, I think for the first time, I kind of realized the power this transparency brings to the business, right? So I was probably the first guy in the financial services ecosystem to start blogging, right? I used to openly answer people's queries, right? As in, you've never probably have seen a CEO. I mean, I still do it till date because there is nothing that I can't say. It's just, I think it's a superpower. Like, if you're just brutally transparent, and and then I think everything else, right? All the decisions that I've taken as a business, that we have taken as a business, is saying that we cannot compromise on transparency, right? As in, we cannot, as in, if customers come on a platform and lose money, we should be transparent about it. I mean, like before SEBI put out these regulations of, mandatory disclosure of how many people lose. We've been constantly actively saying, these are the reasons why people lose money. This is how many people lose money. And that stock market is not, is not like how it's perceived to be the easiest place in the world to make quick money. As in, it's probably the hardest place in the world to make easy money. And so I think just that, like I said, this whole chase of saying we want to be transparent on every aspect of the business, I think helped us, kind of build everything around it. That was like the core. Like the realization was very quick that this is a superpower, and I think a lot of our competitors will have a problem with this. I think one of the reasons we didn't even raise capital, I would say is this, because we didn't want to lose the superpower. Because we're like, at some point of time, if we have to prioritize growth over everything else, would it force us to lose some of these things that today we have the freedom to say and do, right? And because at the end of the day, I think as an entrepreneur, you need to be able to say and do things which is hard for someone else to say and do, right? And yeah, so I think that's really how we thought about, and the transparency doesn't end just with customers, or it's actually internal as well. So we have a forum within Zerodha which we call Inside of Zerodha, and it's extremely active, and I've taken the hardest of questions, like out there, as in this isn't like a moderated, like a forum. I know that a lot of our competitors will never be able to do it because if you're not transparent, then you cannot say things on an open forum, right? And I think that as culture has kind of seen. I mean, that's really what I'm attempting, which is to make sure that like the next person in line after me also can follow some of these things, because this is how we want Zerodha to run in the longer run. And so I think just being brutally transparent to your customer and to your team, has helped us, I think, kind of stick to the broader definition of corporate governance, as they say it.
No, that's actually a fantastic insight that you actually have. When you have nothing to hide, you actually have nothing to lose for that matter. So there is no information arbitrage or something that people can actually hold up against you. And I do agree that, as with the statement you made, that the industry is actually full of black boxes when the regulators actually move into sandboxes for that matter. So I think it is important and essential, therefore, for us to end up actually being a lot more transparent in some of these operations that end up actually being over there, rather than actually closeting a large amount of this. But just picking up on something that you said for that, about the role that investors have and how investors end up actually influencing some of this. Even the large hyperscale growth that we've actually seen, a lot of entrepreneurs place the blame on investors, and a lot of investors place the blame on the entrepreneur to say that, look, you were the one who gave us these projections, now we're actually holding you up to account for that. So given that, sir, given the fact that, sir, that SIDBI is actually the bank that launched 1,000 AIFs in the country and 1,000 fund managers in the country, you are actually placed in a unique vantage point from a domestic capital perspective, and also as a custodian of public finances, actually channeling into one of the riskiest asset classes in the entire country. What are the kind of lessons you can end up actually giving? What are the conversations you've had with your fund managers when it comes to governance? Have any of your managers been affected by the sort of startup governance dislocations that we've actually seen? And what is the playbook that SIDBI is developing as of now to guide these GPs and these fund managers to end up actually speaking to the companies, getting them to be a lot more transparent and making sure they walk the straight and narrow and not get seduced by some of the low-hanging fruit that have long-term repercussions for them as well?
No, Siddarth, I think, we're talking about the LP, the GP, and the founder. Now, frankly, sometimes the LPs do not want the GPs do not want the LPs to come too close. Now, it's natural. So, we're not saying anybody is good or bad, but the larger point is that there is a consciousness within SIDBI that if we've committed nearly now, a 1.2 billion US dollars in this space, what are we doing about it and how are we protecting it? Now, you must understand that we are one amongst several LPs. We might be at 17 to 25%. That's typically the kind of share we would have. But we need to go with the rules, and there is therefore an LPAC, the LP Advisory Committee. Now that, I think, really needs to steer the entire conversation with the founder. And to the extent that through the LPAC, you can actually take decisions on individual portfolio companies. It has to be done with a certain boundary. It has to be, if you ask me, there should be an SOP for this between the GP and the LPs. And you need to therefore remain within those boundaries, because otherwise, you're not allowing the GP to do his work if you were to transcend those boundaries. But the larger point is that somewhere the portfolio company is driven by the GP so hard that I actually feel at points of time, and we've seen some aberrations in the last 12 months. Now, 2 of those were companies where SIDBI has, is there as an LP in those AIFs. Now, when we drill down further, we know that the GP is just chasing that quarter-on-quarter profit. And this was a problem with, the Satyam case, if I were to go back, some number of years ago. Now, where does the LP come in and restrain the GP? There's no easy answer to it, but I think that has to be done because the LPs cannot remain passive. You are therefore will be called to account because somebody may say that, listen, as a stakeholder, what is it that you are doing? So it is something which we should possibly flesh out, and it should be done within the industry. I would not even invite, SEBI to come into this, because as an industry, as an AIF industry, which is now blossoming, it's got a huge way to grow going forward. If we have to be responsible, we have to become a self-regulatory organization amongst the AIFs, and therefore there has to be this larger debate between the LPs and the GPs as to what is the LP's role. Now, we know for a fact that we can determine the kind of investments that are done by the GP, because you have a 75% share of voting, and if you get that, you can actually sort of direct the GP. Now, I think these are things which have not really been tested. And to be very honest, I can admit before all of you that as an LP, SIDBI has not really taken on an activist role. Probably, we'll be, blessed by our GP saying, they're asleep. They're not really interested in what we're doing. But I think somewhere we have to, sort of heed the wake-up call. We have to move forward and, interfere a little more in what the GPs are doing. And I think this is really the right way to set a trend in this industry, which we are very clear that it is an industry which is not within the purview of SEBI as a regulator in terms of, the investee companies or the portfolio companies. You're there only because money is being collected and you don't want, the kind of CIS related issues which used to take place. So, you are here more as being regulated for collecting money rather than being regulated for investing that money. Now, that investment is really where I'm saying, let us make it a, a sort of dialogue between the GP and the LPs, and let's strengthen that dialogue. Let's even put it into some kind of a guidance and let people try and abide by it.
No, sir. So you do actually raise a very important point about the unique straddle point that an AF has. It's actually a bit like my Hindi is a little bad, so just bear with me. I'm actually from Bangalore, in the south of India. AF is actually like the dhobi ka kutta, na ghar ka, na ghat ka. So you end up having a situation wherein you have the regulator who's actually more for public markets and retail investors, end up actually regulating a product that is meant only for sophisticated investors and allocates a large number of the assets, where even on the asset side of the balance sheet is not regulated by SEBI, and the equity side and liability side is also not actually regulated by SEBI, but yet SEBI's place in this sort of unique vantage point to end up actually regulating this kind of industry. And the point that you actually brought about it, I think the industry should also, given the fact that it's a 100 billion, it's an 8.3 lakh crore industry, grown at a CAGR of 112% from December 31st, 2012, all the way to March 31st, 2023, for that matter. I think it's about time the industry evolves to actually start regulating itself. I think the important part is also from the regulator's standpoint, they don't want to interfere. They expect maturity to come in from the entire industry, where the industry says, look, we will actually create a set of operating guidelines and create these sort of rules. And we will enforce it amongst our members to make sure that anyone who's not walking the straight and narrow, we end up taking suitable action against them. Otherwise, we end up with a situation, and also the panelists in the first, the panel we're actually speaking about, where the regulator ends up actually reacting to bad actors in the ecosystem. And the unintended consequences of that are actually felt across the entire industry.
So there are some hygiene issues in which I think the regulator should, keep the bar high. So it's like, the demat of shares. Now, it's the demat of shares of the portfolio companies, the demat of units which are held by the LP. I think these are great steps forward. The need for standardization and valuation, I mean, can we disagree with that? I mean, it has to be there. Otherwise, we're not talking the same language. I mean, what you are calling, unicorn, I will say, no, it's a sunicorn, so. So, I think, the basic minimum hygiene standards are a must. But beyond that, if you want to make this grow, and you actually are now calling upon this global capital to go forward in immensely different areas. We're talking about deep tech, which is now suddenly and rightfully so, coming up on the horizon. Now, with deep tech, you're talking about several $1 billion, and we would be, happy to have global pools of capital looking at India as a mature market where governance is, sort of expected to be arising from within the dynamics of the LPs and the GPs. And you have a regulator which sort of is asking the right questions, but does not have to enter and, bring that big stick down.
True. No, I think I think the regulator is also slowly moving towards that, where they expect the industry to end up regulating, and they prefer to create the rules at the playground rather than telling you who has to bowl at what particular point in time, what stroke you end up playing, and actually becoming more prescriptive that way. So coming to you, Nithin, as of now, I actually don't want to speak to Nithin, the entrepreneur, but I want to speak to Nithin, the investor. Through Rainmatter Foundation, Rainmatter Capital, you guys have become very active in the entire early stage space as well, taking several investments into larger companies, into companies that are fledgling and growing up also. But given the fact that you primarily invested in the listed markets, where there are active market mechanisms to punish and reward bad behavior. For example, if the investor actually puts out a negative report on a particular company citing governance lapses, the stock price immediately falls. They can end up actually liquidating it and moving on. So bringing that kind of mindset, coming into the unlisted space where you don't have that kind of latitude. If you have a problem, I think we've also seen where investors have walked out en masse of startup boards for that matter, but companies still continue, life actually goes on. Those are, of course, nuanced issues that go far deeper into that. But what are the kind of market mechanisms you would like to see evolve in the startup space, similar to the listed space itself, to make sure that bad actors are actually held accountable for their actions? Taking them to court, no investor wants a reputation of dragging one of their founding companies to court. So how do you, in your unique position as a founder, an entrepreneur who's built something, as well as now donning the investor's shoes, what are kind of mechanisms you would like to see, and what kind of advice can you end up giving for budding entrepreneurs for that? to your own portfolio companies for that matter?
No, I mean, I think, like what Munger says, right? As in, show me the incentive, I'll show the outcome, right? I think a lot of these issues, like Sir rightly said, also comes because of the investor itself, right? I mean, this is a question that we keep asking internally, right? As in, what is the value we bring as Rain Matter to a startup? As in, why should a startup raise money from us? And the way we have structured it is it's as perennial investments. Is that we are invested forever, right? So that means we are not in a hurry to make money, right? As in, I think the whole issue, as in wherever I've seen issues, is really, I think it all comes down to that, which is like someone trying to grow too fast and then compromising on a bunch of things. Now, can you just blame the entrepreneur for this? I don't think so, right? As in, I mean, you have to kind of blame the investors as well. And so I think we have to fix that. And I think market itself corrects over time, right? I mean, I think this, whatever is happening right now, the lull will fix this problem. I think, as in today, the investors ask for the right kind of questions. And so since the investors are asking the right questions, I think the odds of the issues that we have seen in the past will probably reduce. I mean, I'm sure a lot of issues are currently hidden in the closet because this is the legacy of, the bull market in the Indian private market space. So it'll probably start showing up. But I'm saying the new vintage of investments that's happening now, the odds of corporate governance issues showing up, I think will be much lesser because the investor is asking for the right kind of questions and he's benchmarking, correctly. Now, but at the end of the day, there are going to be rotten apples, as in the sense, it is, it's how it is, right? As in, there are in public markets, there are in private markets. If someone wants to make money quickly, as in, he's going to compromise on a bunch of things. I mean, I think one thing that we don't want is that you don't want regulations for that rotten apple kind of slowing the entire sector down. And we've seen this happen, say, in broking industry. We've seen this in the banking industry, etc. Right? Is that because of a few rotten apples, you almost make it very hard to innovate, right? As in, because regulations eventually end up stifling innovation. And at the end of the day, we want to grow this country, right? As in, like each, the way I think about what we're doing in Zerodha and Rain Matter is that we're participating in the growth of this country, and that can only happen if we can continuously innovate. Right. So I hope what doesn't happen is, we get up one of these days and there's a big blowout and a bunch of regulations saying this is how you need to run your business. Right. I mean, even in the private space, right? So it's, no, I think the first fix here is for investors to, be pushed to ask the right critical questions. And I think that we are already seeing. Other thing that I've been thinking about is that India is a hard market to build a sustainable business, a resilient and sustainable business. It's not a US, right? So the fund life cycle in India should probably not be the way it is in the US, right? So maybe it should be much longer, so because if it's much longer, then the investor has enough leeway and time to allow the startups, to grow. The LPs are not asking the GPs that where is my money in like 4 years, 5 years? So maybe they're gonna wait for much longer period of time. So I think maybe there is a use case here to say that should the fund life cycle in this country be much longer, because it takes a much longer time. At the end of the day, India is a poor country. I mean, we need it to become richer, so for a startup to, the way I think about Zerodha is that, we started in 2010, but there was 10 years spent before that as a trader and as a sub-broker, etc. I think of Zerodha as 23-year-old business, right? And we got lucky financially only after 16 years, right? So if someone had said, dude, get lucky in 5 years, I mean, it wouldn't have happened. And I'd probably have had to compromise on a bunch of things. So I mean, I think, these 2 points maybe.
No, I think that
Can I just butt in there?
Please,
just
please,
a point to Nithin. I mean, I think you alluded to the fact that the Indian investors are, therein for, a shorter period. And your ask is really that should the funds not be for a longer time or a life period. But there's nothing in the regulations which prevents you and me putting our money together for a 30-year fund. It's allowed. So, it's just that the investor behavior is such that you want to see your returns in 7 years. Now, you don't probably trust the investment manager sufficiently enough, saying that, no, I mean, 7 years is the max, now I want my money back. Now, that's really the, sort of hurdle that we have to cross. So we are actually talking about the deep tech space, where we're saying that we need 15-year funds minimum, because otherwise you're not going to be able to incubate that company sufficiently well. And you might end up, looking for a secondary market where valuations again will be entirely different. So, we have to grow that culture. And in fact, some of the greatest global investors have 30-year funds. So I think, that's something which maybe, you should look at. I mean, you should be a, a pioneer in that.
No, one of the reasons we talk about it is the way we've structured it. I mean, we have the freedom to do this, so it's, because it's our own capital. But the way we've structured it is saying it's a forever fund, in the sense we are perennial investors and we're going to stay invested forever, So, but I don't think everyone will have the freedom to be able to structure stuff like this. But I'm saying it should maybe not be 7, but like you said, it should probably, you need to, like how you do that purchasing power parity between US and India and say, what, India should be this or that, So maybe it should be twice of what's in the US and not, cut, copy, paste to what's happening in the US.
No, very true. I think we've always been scarce of capital. I think now we're also scarce of patience. And patient capital, I think, is a bigger myth to end up finding than anything else. But I do actually like what you said, Nithin, about the fact that investors are now looking, rather than just being greedy, they're looking at the DD as well and taking more informed decisions to what they end up actually doing. But just around the role of investors, as well as how they end up shaping these sort of fast-moving enterprises. Vinod Khosla of Khosla Ventures actually had a very interesting interview that he did recently, where he said that he doesn't allow some of his team members to actually end up taking board seats, saying that, look, what role are you going to end up actually playing on the board? Have you actually built this kind of business, gone to the kind of travails that a entrepreneur has, to end up giving them that kind of information that's actually relevant at that point in time? Because what we've seen happen, especially in the unlisted space, for that matter, the role of the investor on the board is not for the stated purpose of increasing governance or actually making the company a lot more sustainable or anything like that for the matter. The role of the investor on the board is far more myopic, because it is there to ensure that the investor's rights are actually protected. And given the onerous obligations that are placed upon them by LPs, as well as by regulations to make sure that their interests are actually best protected, we are actually seeing the convergence of, I would say, more myopic behavior that would be counterproductive and counterintuitive to the overall growth of the company itself. Because corporate governance, as Mr. Damodaran said, is not just a factor of looking after shareholders, it's looking after stakeholders as well. If any of these large companies end up actually going down, it's not just investors who end up losing money. That is actually the name of the game. It is equity risk that you are taking. But the dislocation in terms of jobs, the dislocation in terms of services provided, ends up actually increasing the entire ambit that's there. Whereas investors have a counterpoint to say, look, the way new regulations are written as of now, even if I didn't participate in the decision, there is a good chance that I will be held accountable for matters that I didn't necessarily give my consent to. So there is a gap in the regulation, especially for unlisted private companies, for that matter, compared to the listed ones who are there. So I just want to get, and this is something for the both of you, it's more an open question. What are the roles, given the fact that the investors sort of boxed in by that matter, from the LP side to make sure that they protect their interests, from the regulation side where they're held accountable for things that are out of their concern, and from the promoter and the stakeholder side where they have to balance out their own needs of a short-term fund, of generating liquidity, creating IRR, etc., as well as ensuring more sustainable businesses. How should investors actually end up navigating this sort of trilemma and this sort of dynamic that ends up coming in?
So honestly, I mean, if we were to just keep regulations out of the picture, you are talking about a GP going and investing and sitting on the board of a portfolio company. Now, the only thing that he has on his mind is how to make his investor happy. His LP needs a return, because he's already thinking about the next fund that he needs to raise. So, you're talking short-termism right through. I think, sir, you said it. I mean, the extreme short-term and money, they have a corrosive effect. I completely agree. Now, here, we're not talking, sort of even 5 years and 7 years is short-term. If the GP's only concern is that I have got a 100 crore fund, and now, with successful investments, I'm already looking at setting up my 500 crore fund. Now, what does he expect? He has to put on his pitch deck the fact that 5 of his 8 companies are giving an IRR of 18% plus or 64% or whatever it might be. Now, this is really the, trilemma or, the simple conflict of interest. I mean, let's not get into too many variables. It's just a single variable of a conflict of interest where you do not really have the interest of the business at heart. It is about your returns and your management fee from the next fund. So, this is really how it's sort of driving the industry. My view is really that if an LP wants those returns from the from the portfolio company, they need to sort of look at a much better secondary market. So, why have we not seen the secondary market develop? Now, this is really coming close to the public equity market. You have the entire, exchange and depositories were created only because you have a secondary market. Now, if there were to be a large secondary market within the unlisted space, then maybe you would have the ability for different investors with different risk appetites coming in at various points of time and therefore holding on to that particular portfolio company in a much better way. So that's a lovely bit of music, yeah. So
is that a kind way of saying like lunch is served? Or? Huh?
So, I mean, this is really my take where the LPs have to, get an exit, and therefore we've already seen the graduation within the Indian space of the angel and the VC and the, sort of Series C and then the PE. So that is coming in, but let's grow the secondary market. I think a lot of troubles that we currently have right now might, abate.
That's actually a very interesting thought, because one of the greatest marks against the Indian AF industry and the VC industry has been the fact that your translation of paper gains to actual hard cash. I think that's actually a fairly large chasm to end up actually doing. And like you said, there are restrictions, some regulations. SEBI doesn't allow you to extend a fund despite 100% LP approval for that matter as well. So it places the fund manager in a unique position of mismatched expectation, where they have to maximize gains to end up actually doing within the shortest span of time. And that ends up actually leading to kind of undue pressures that come in over there. But Nithin, the one thing I actually want to come to you on that. The entrepreneurs also have a role to end up actually playing over here, because valuations are ultimately is an expectation of the entrepreneur, say, I want to be valued at so much, and they end up actually giving extremely optimistic projections for that particular matter. And I don't think an Excel sheet has ever refused any number you end up actually feeding into it. And life doesn't work as a sort of linear equation for that matter. You can't just write 5 numbers, drag it to 20 and say, this is how I'm going to end up actually growing over time. So how would, given the fact that the theme of the event is, theme of this panel is also corporate governance too late, what is the role that entrepreneurs and what is the obligation and responsibility that entrepreneurs need to end up taking up on their table? Because investors can't be the only ones to end up blaming for that matter. Even the entrepreneur can decide, I want to build a 30-year business as opposed to a 5-year one. So they end up committing to a 5-year exit, which sort of exacerbates the entire problem for everyone involved.
Yeah. No, I think, I mean, that Vinod Khosla interview, right? As in after that, I was thinking of ourselves as investors, saying, what is the value that we bring on the table, right? As in, because I think what Khosla said in that interview is that operators can somehow bring more value. And I was thinking, as an operator in a company, what value do I bring to a new company? I mean, because everything that we did at Zerodha, I mean, I think for all successful business, right? It's a lot of happenstances, right? I mean, right place, right time is so important, right? So my advice on how we build Zerodha may not be really apt for someone else starting today, right? As in, so as an operator, me giving this advice, does it even help him or not? Is a question, right? As in, so I was thinking about it and I was like, what's the value we really bring on the table as someone who's done this is to set the expectations right? I mean, like the one thing I think, like one of the best things about my life is freedom that I have to say, and do what I want to say and do, right? And that's because, you set the expectations right across the board, right? And I think what happens is, I think this was a phenomenon of the last 4-5 years of Indian bull market in private space. Overselling got incentivized, right? As in, if you, the kind of guys who raise money, if you look at it, they're actually good salespeople, right? I mean, a lot of investors have ended, funding people who can speak well, right? And who can sell a dream of sorts. And that's not like, it's hard to, like you said rightly, right? As in putting up an Excel sheet and saying, dude, I'll get here at this pace. I mean, I usually, like there's this, a lot of these startups from the fintech space, the people who are building for capital markets, they come and say, Nithin, India has 3 crore people who are investing today actively. It'll be 30 crores in 5 years. I'm like, dude, what are you smoking? I'm like, where will 30 crores come in 5 years? So, and typically, yeah. So I think if right from day one of the business, if people think of this expectation as a long-term obligation, right? Because this what you said as an expectation, you are bound to it through the journey of your business. Like, it's like going on that first date and marrying someone, right? As in, what is that expectation you set on that first date, right? As in, and because then if you set the wrong expectation, it's going to be a bad marriage, right? As in, there's no going around it. And you're absolutely right. I mean, this is one of the reasons why we talk about this actively as well, because today, I get a lot of credit for Zerodha being whatever it is. And trying to tell entrepreneurs at every stage, it's harder for people who already raised money, but we also, because of Rainmatic, get access to a lot of people who are just starting up. And the one advice I usually have for everyone is that you rather undersell versus oversell, and because if you oversell, then you're forced to take decisions to meet that expectations that you've sold, and then you will have to end up compromising on a bunch of decisions you wouldn't have taken. And also this thing, about people who come to trade the markets also, the problem is the same. People think it's easy to, make money trading the stock markets, and people think it's easy to make money building a business. It's hard, as in it's like, it's probably like, I don't know if you heard Jensen's recent thing, on Acquired, the podcast.
Yeah.
On NVIDIA, right? As in, when asked if he would do it again, he says he wouldn't.
He said no.
Right? Because
Yeah.
it's so hard. Would I do this again after everything that I've gone through over the last 20 plus years? Maybe not. I probably would go do well in my engineering college and get a job or something like that. If I have to redo this again. So yes, I think it's just, I think operators have to set the expectations right with new entrepreneurs saying, it's hard. It's not easy to make money. Building a business. I usually, through the foundation, we work in the climate space, and every time I meet anyone, any scientist in this whole agriculture space, my question is there a way to grow a tree fast? Is there a way to grow a forest fast? Like I want, in 3 years, can we have can you restore a piece of land and grow like a, like a biodiverse forest? And they're like, dude, you can take a tree, put some steroid, and you can grow one tree fast. But a forest is an interconnected system of like so many things, and this is not something that you can do it in 3-5 years. And a business is like that. It's not one person sitting and doing one thing. It's an interconnected kind of a system, and it's really extremely hard. And the chances of doing it and coming around successful is also very, very, very low. So I think these are some things that people have to kind of anyone building a business has to kind of ingrain, and not, like I said right at the start, I think look at everything as a risk and as an opportunity, and maybe think of the risk before you think of it as an opportunity.
No, so I think the analogy of a forest is fantastic, because I don't think capital can end up actually raising a forest quicker. It's the wrong kind of liquidity applied to the right kind of asset that ends up coming up with that. But the point you made on entrepreneurship, I think, is also fair. I think that's the reason why we've seen most of the founders end up being fairly young, because they don't know where they can go wrong, for that matter. So I think just being actually blind to some of the outcomes that you end up facing actually emboldens you to take those kind of bolder bets and to actually create that kind of value that comes in there. Given the fact that I think we have about 8.5 minutes left, the theme of this entire panel was actually startups and corporate governance. Is it too late? So the open-ended question to both the panelists as of now: what is the right time to end up instituting governance in a startup, for that matter? Is governance really a function of size or scale? Because startups accelerate through the entire business journey within the short span of time, courtesy of capital, as well as the high growth that's predicated in that. But the flip side of that is something that becomes part of corporate culture and corporate DNA becomes impossible to dislocate over time itself. So what would be your final thoughts on when should a startup end up instituting corporate governance? Or are there situations where the company becomes too large to end up actually instituting these kind of frameworks and these sort of guardrails that can end up creating value for everyone?
So, I think it's, in my mind, I'm very clear that startup is serving a particular constituency and is solving a particular problem. And therefore, if you stick to the knitting, I think corporate governance is inherent. You cannot go wrong if you are serving your customer well and you are therefore solving problems of potential conflicts in favor of your customer. So, you have to get it right because you are not extracting something which the customer is unaware of. So if we were to look at any startup, it's really the pressures that the startup gets from, I would say, the VC and the private equity saying that you need to grow 10 times faster. Then you start looking at the regulatory environment around you and say, this is so onerous, let me cut corners. So, it's really a, set of, variables that a startup faces. And at each point, you end up taking a decision which is always in favor of a quicker return. Now, that is really, I think, somewhere we need to sort of put part of the blame on, onerous regulations and the lack of ease of doing business. But I would really say that if a portfolio company wants to take 5 years more and therefore not invite a private equity on board, they probably might be better off. And therefore, having said that, a private equity has to come in with a very good understanding of what is corporate governance for that particular company, and therefore is infusing a greater amount of corporate governance rather than eroding it.
Your thoughts?
Yeah, no, I think if corporate governance is running a business in the right way, I think it should be from day one, right? As in, I don't think there's anything early or late. As in, you should just do it right from the start, and it becomes easy. Then it becomes part of the culture. The other flip side here is that if you make corporate governance as a bunch of check marks, right, as in like a tick boxes, I think you then potentially start doing something like what regulators tend to do, right, which is kind of stifle innovation, right? Because these tick boxes then become about, it slows decision-making process. See, at the end of the day, I think in today's world, it's about the fast beating the slow. There is no status quo, like you can, get disrupted anytime, right? So like the way we think about Zerodha is that if we are slow in the way we are thinking about our decisions, you will, someone will do to us what we did to someone else. It's just that, we'll probably be irrelevant very quickly. So how do you? I think for entrepreneurs, thinking about this is that you have to do it well, but also you need to make sure that your decision-making process doesn't end up taking time. Like we deal with banks, right? I mean, it's so slow. As in, it's. I think today banks in India are just covered by the fact that becoming a bank is so hard, right? As in, if not for that, I think banking in India would get disrupted. So it's that it's I think here as an entrepreneur, like I said, it's about risk to reward. I think we need entrepreneurs to think prioritize long term versus short term, like what Sir rightly said, and that'll probably happen if investors are aligned with the vision. Two is to look at everything as a risk, but not slow the business down. As in, I think this is something that as a founder I keep thinking about it. Is that if tomorrow morning I am not the CEO of this business, and we end up hiring someone, if I'm always constantly saying think about it as risk to reward, what if he just prioritizes risk and doesn't look at anything as an opportunity? As in, then I don't know. I mean, I don't know the answer. Probably as I grow more and I'll probably have an answer to this question, but I don't know what is the right mix there. As long as your founder mindset, you're going to look at everything as risk to opportunity. But as soon as you put executives on board, either they potentially go only as opportunity or look at everything as a risk. How do you make sure they look at it as a right balance? I mean, I don't have an answer to that, but this is something I keep thinking about it because I'm like, what if tomorrow morning I get up and I don't want to be the CEO of this company, right? Like what happens then? So,
no, that's actually a fantastic way to end up actually putting it, because I think ultimately with great capital comes great responsibility, but also great liability for that matter to end up returning that. Because I think it's also contingent on the entrepreneur to end up actually deciding a value that they can end up actually growing into, rather than investors holding them accountable to say, look, this is the valuation you promised me, here's your deviation from your plans as 70, 80, 90%, how are you going to grow into it? So that kind of pressure ends up becoming a self-fulfilling prophecy, because the moment you seek a high valuation, there are much higher obligations to end up actually delivering upon that kind of valuation, end up actually growing into it itself. So it becomes a sort of very weird, in physics it's something known as a three-body problem. Where for a two-body problem, it's very easy to end up figuring out and calculating the forces and applying to it. But the moment it becomes a three-body problem for that matter, it is impossible to figure out all the forces that end up actually acting upon that entire system. And if you look at startups also as of now, you have fund managers on one particular side, you have the entrepreneurs on the other, and in the last, you end up actually having regulation, where each one ends up actually pointing the finger. It's one like the old Spider-Man meme. Everyone points the finger at the other person. No one knows who's right, no one knows who's wrong. But I think the important part is to actually take a collective decision to make sure that be transparent when it actually comes down to it, be accountable for every decision that you make. No one has a gun to your head to say you have to grow at 100% month on month or year on year or anything else like that particular matter. If you do require more time, be mature about it, be transparent about it, as Nithin actually said, and make sure you end up actually finding the right kind of investors to match your kind of business model to end up actually doing about. So I think with that, we can actually bring this entire session to an end as of now. We do have 1 minute, 55 seconds for that matter, but I think since lunch is fairly imminent, never be the person between an audience and lunch. I've actually learned that sitting in the audience itself. So with that, I'd like to draw this entire session to a conclusion. Thank you very much, Mr. Ramann. Thank you very much, Nithin. Hope you feel better. Hope you feel better over time also for that. I hope this is not reflective of the current market for that matter. You don't fall sick when the market goes sideways.
There is no winter. There's a lot of money available in the country.
That is true. That is true. I think the winter is also waiting for people to, you're looking for the right opportunity rather than just running through inertia. So I think that's also circumspect, and it's an important aspect to keep in mind for investors for that. So thank you very much.
Thank you very much, sir, for those deep insights into the world of startups. We actually heard violins in the middle, which means that everybody was falling in love with what you all were saying. All right, well, now, ladies and gentlemen, to do us the honors, we're now going to welcome on the stage Mr. Damodaran to kindly do us the honors once again. Ladies and gentlemen, these mementos are truly special because they're caricatures of our speakers, our panelists. Our moderator, ladies and gentlemen, put your hands together. Thank you so much, Mr. Pai. Thank you. We'd like to thank Mr. S. Ramann. Thank you very much. There's also a certificate there for 10 trees that are going to be planted in your name in the Sundarbans. And we'd like to also thank Mr. Nithin Kamath. Ladies and gentlemen, thanking our panelists,